Thank you so much.
Yeah.
Um, I wanted to talk a little bit about estate planning in general. I don't know the level of if you guys, some of you have been through the process of doing estate planning. Some of you may not have. I want to try to make it interesting for those who haven't done much planning, but also uh, put in a few nuggets so that we can talk about some of the tax benefits that we can derive from estate planning. Now, one of the things that there's usually 3 or 4 major reasons from a financial standpoint that you would do an estate plan, and there's 3 or 4 major reasons from a family preservation and loving of family issues that are addressed in the estate plan. So one of the first financial reasons that people do estate planning is to avoid probate, and I'm sure you guys have all heard about that. The example I like to give about probate is that, say you only had one asset in your estate and that was your home, and you go through probate because the home was in your name alone and there's no one else it would automatically go to. And so that home is worth $1 million, but you have $900,000 of mortgage on that home. And I wanted to let you know what the costs of the probate are, even if you only have $100,000 in equity. There's attorney's fees for that amount of home of 23,000. There's administrator fees of 23,000, and there's court costs of $2,500, and that's just for that one home with $100,000 of equity. And then it takes about 2 years to actually complete a probate. So most people are really interested in avoiding that, and it makes perfect sense. And some people don't realize, but the trust, a living trust, or what some people call a family trust, is the only means of avoiding probate. If you have that document and you titled your property in the name of that document, it's not going to go through the probate process. It'll be handled through your instructions in the trust. Um, so that's really one thing that people get a little confused about is that wills do go through probate. If you have a will, you're going to go through probate, or if you don't have a will or trust, you will also go through probate. So that's the first financial reason people want to avoid those costs in those time periods. The second major issue is capital gains. And the Biden administration is really have made a proposal recently that will really affect this area, which has been, I'd say over the last 40 years, one of the most beneficial things that all of my clients have had access to. And what I'm talking about is a step up in basis concept. So what that means is, say you bought your home 30 years ago for $100,000, and now it's worth $700,000. Okay. Um, when one spouse dies, that property gets reassessed at current fair market value. So the new cost basis goes from 100,000 up to 700,000. And if the surviving spouse had to sell that property and listed it with Julie, then that that they'd have to pay capital gains on the 700,000 less 100,000 less 250. So that's about $250,000 worth of capital gains, which is taxed at about a 20% rate for a lot of people. And so you have a $40,000 to $50,000 tax that you have to pay if you don't have a step up. The step up in basis establishes a new basis of 700,000 for that house. So if you sold it for 750 or 800,000, you have another 250,000 you can add to that. So you're not going to have to pay any capital gains if that property is owned as community property and gets a step up in basis. So that's one of the huge advantages that's available to us today, is that step up concept where the new owner of the home gets a completely new higher basis based on the fair market value of the home at date of death. And then in the case of a trust with a community property, when the second spouse dies, in many instances, say the kids inherit the home with a cost of $1 million. They also get that $300,000 difference as a step up. So their basis in the property is $1 million when the second spouse dies. So that also, we're saving from 100,000 up to $1 million in capital gains we're paying zero. So that's one of the huge advantages of estate planning that allows us to get that. Now, the Biden administration has proposed a tax that is payable upon the death of the first spouse and the second spouse when the property gets to a value of over $1 million in step up. So a house, in this area, $1 million is pretty common. So any house that has $1 million in capital gains would potentially be taxed at a 43% rate under the Biden administration, as opposed to about a 23% rate would be the highest rate now. So we're watching that legislation. It hasn't passed yet, and I know there's a lot of pushback on it, but that's one of the greatest benefits of estate planning, and has been for years, to get a complete step up. And the tax that Biden is proposing would be paid when the spouses die. And as in the current law, the taxes, if there are any, wouldn't be paid until the property's sold. So that's another huge difference in that tax consequence. So I had a client recently, and the father, this happens a lot. The parents decide they want to gift their property to their kids. And so he had gifted his property that he bought for about $50,000 to his only child daughter who lived in the house. And then he became very, very ill. And the daughter told me that what had happened. And I said, well, we need to for sure get you to give that property back to your dad, so that when he dies, you can get that step up. Because if he had died in the current situation, her basis would have been 50,000, and if she had to sell the property, it would have been about a $600,000 capital gain, which at 20%, you can do the math. It's really, really expensive. So capital gains savings is a great benefit of doing estate planning. Now, currently, the estate tax amount that was passed, I think during the second year of the Trump administration, was to increase the exemption amount, and I'll explain what that is, to about 11.7 right now, 11.7 million. So what that means is, if you have any amount over 11.7 million, you will pay a 40 to 50% estate tax on that amount. Well, of course, that doesn't affect very many people. And the way the law is structured, it's going to drop to about 6 to 7 million in 2025. So if that's the case, that's going to affect a few more people. But the Biden administration wants to bring that down to 3.5 million. So, and every dollar that's taxed over that amount would be, heavily taxed, 40 to 50% rate. So we have a lot of flux going on in that area, and we don't know exactly what it's going to be. So when I do my planning for my clients, I have to make sure that we have some flexibility baked in, so that I can potentially double the amount that we can exclude from estate tax if we need to. So that's one thing that estate planning will allow us to do, is double the amount we can protect from estate tax. So that's another financial advantage of doing the estate plan. I also wanted to talk a minute about the Prop 13 property tax issue. You guys recently voted on Prop 19, and it was kind of interesting. The way they sold that to the public was that it was going to benefit older people because they could move 3 times and still maintain the same property tax. And it was also going to somehow benefit firefighters. They didn't tell you when they advertised about that it was going to do away with some of the most beneficial programs we have as far as keeping property tax intact. So what that means is, in the past, if you were a parent and you died and your child inherited your property, they could file documents, it's called a Prop 58, and maintain the same property tax that you had, not only on your personal residence, but on all other real estate up to $1 million. So rental property up to $1 million, we could protect the same property tax that you bought the property for. So in many cases, that's thousands of dollars of savings every year for the kids when they inherit the property. Prop 19 did away with a lot of that. So in the case of Prop 19, any real estate that is not owner occupied is going to get a step up automatically. And the owner occupied property, in other words, if the child of the parent has to prove that they're going to live in the property, if they can do so, then they have up to $1 million that they can protect from property tax increases. So any amount over that, they're going to have to pay higher property tax. So this took a huge chunk out of Prop 13, and most people didn't even realize what they were voting for because of the way they presented it. And there wasn't really a strong kind of a pushback from any group that was really kind of informing people of what that was going to actually entail. So I just wanted you guys to be aware of that. We did a bunch of trusts that transferred property right before the February 15th due date to try to take advantage of the old law for a lot of people who wanted to gift their property to their children. So that unfortunately, that boat has sailed. So there's really no way at this point to protect people and use the old basis in property tax. We have to go with the new Prop 19. So another thing that some people don't understand or realize is that the different types of assets that you have are treated differently when you do estate planning. So there's assets which are called trust assets, which should be in the name of your trust. Those things are things like real property, corporations, LLCs, bank accounts, after-tax investment accounts. In other words, investment accounts with an investment advisor who you've already paid the tax on the money that's with them. Those are all called trust assets, and those are controlled through the trust document. So while you're alive, those assets are in the trust. You earn your whatever income you're going to earn from those assets, and they're reported to the IRS on your trust tax return. Then there's other types of assets which are not trust assets. Those are things like 401ks, IRAs, annuities, life insurance. All of those assets do not go through probate. So even though they're not in the trust, they still will not go through probate. They all have beneficiaries that you can name to them, all those types of accounts. So those accounts, the non-trust accounts, are managed while you're alive. If you become incapacitated, they're managed by the powers of attorney. So, and if you pass, and those assets, of course, are in your estate, the non-trust assets are managed under your will. So a lot of people don't realize that we have to protect both types of assets when we do estate planning to make sure they're going to go to the right people at the right time. So when you do a complete estate plan, what you're looking at is you're doing a trust. The trust will take care of those trust assets, and you will determine how those assets are going to be managed during your life, after your death, and even into your children's life. And then we have the power of attorney, which if you're incapacitated, will allow someone to contract for you, manage your 401k, all of those types of things if you're not able to do it yourself. And then the will, we contact those companies that are holding those non-trust assets and we get them distributed. So a lot of people don't realize that those types of documents actually handle all the assets that you might have. We also have, of course, all the healthcare documents. We have HIPAA, the healthcare power of attorney, and we have documents which will put all of your tangible personal property around the house, things that don't have title to them, like your appliances, your clothing, your artwork, your fixtures, all of those types of things. They have to be in the trust as well, so that we make sure that we don't go through probate. And the number that we have to worry about in going through probate is if you have assets which are not in the name of the trust, which equal about $166,000, that number triggers probate. So if you have assets over that amount that are in your name and you die and you don't have any beneficiaries or joint owners, you're going to go through probate. So then I want to talk a little bit also about some of the family preservation reasons why we might want to do estate planning. And if you guys have any questions, feel free to chime in. This is very, very informal because it's just a small group. And so the first thing I want to talk about is, other than financial reasons, how does the trust benefit you personally? And one of the things that the trust does that no other document can do is it names an incapacity person we call them a trustee, who would be responsible for taking care of you, paying your bills, paying your taxes, making sure you're physically taken care of if you were to become incapacitated. And believe it or not, about half the persons in the world during some portion of their life are incapacitated. So this really comes into play and is very important. And the incapacity documents are the trust for the trust assets. And like I said, the power of attorney for the non-trust assets. In incapacity, some people don't really understand what that is. Most people think it's dementia. It is dementia. It can be a blindness. It can be an injury. It can be any kind of psychological problems or drug problems, anything like that. Even severely old age can be incapacitating. So those things would all trigger the incapacity trustee or the power of attorney agent to be named. And so it's very important that those people are able to fairly easily work through the process of getting control of your assets so that they can assist you. And this is one of the areas, incapacity is one of the areas where your children can very much be affected. So say you have one child who's taking care of you in your incapacity, and they're spending money for your benefit, and all of a sudden, say, oh, if they've taken care of you for a couple of years, and they buy a new car. Well, the other kids may be wondering to themselves, where did Sally get the money to buy that new car with? Was that money hers, or was it her, our parents is she spending our inheritance, in other words? So there's ways to give more visibility to the other children as to kind of protect their interest in the estate and make sure the money's being spent properly for their parents. But there's also ways to protect the parents from one child abusing their own funds and taking care of them. And if the kids get along really, really well, and they're willing to share the responsibility of taking care of the parent, that's one good way to avoid these kind of issues. Because if you have two children, both of them have access to the bank accounts, and both of them see what the other one is doing. And so it avoids this kind of issue where the kids might distrust each other after a period of time. One of the most important things about incapacity is that whatever type of incapacity it is, we want you to have the maximum amount of control over your own assets. So if you have dementia, of course, the payments are going to be made for you. You're not going to control the funds yourself because there's so many people out there trolling for older people with dementia and stealing their funds. It happens almost every day, sadly. But if you're blind and otherwise mentally acute, you should be very, very involved, even though you are incapacitated in your taking care of your finances. So you've had a stroke, mentally you're sharp, but maybe you can't use your arm to write checks. You would be very, very involved in the incapacity care of your own funds. So one of the things we like to make sure of is that you have maximum power under your current circumstances to control your assets, even if you are incapacitated.
Oftentimes a lot of overlap. So knowing somebody like Brooks is very, very important. What I'd like to do is take a little bit of the mystery out of tax planning. Would you agree that in general, it seems to be pretty mysterious? Would you agree with that? Okay, well, let's sort of dismantle that a little bit. Everyone should start with a mission statement. And it doesn't matter who you are. But my question to you is, have you ever read or heard the IRS's mission statement? They have one. And what the IRS says, and this is directly off of their website, the IRS mission is to provide America's taxpayers top quality service by helping them understand and meet their tax responsibilities and by applying the tax law with integrity and fairness to all. How are they doing? A lot of challenges there. You know, there's over 70,000 pages to the tax codes today. No one knows them all. No one. I certainly don't. And that's why folks specialize. That's why CPAs primarily specialize in compliance to the law, and which is also the reason why most CPAs, as an example, really have no idea at all how to do proactive tax planning because they were never trained in it. But there's so much in law that is there that is a benefit. But like mining for gold, you have to mine the tax laws to find those benefits. And I'm sure Brooks would appreciate that and support that in the estate planning field as well. Now, he touched on the Biden tax plan. Let me. Some of this is going to overlap a little bit as to what Brooks had shared, but I think it's still worth being aware of. On a personal level, and this is one of the few positive things I think might come out of his plan, and that's they're restoring or reestablishing the first-time homeowners credit, home buyers credit of $15,000. Julie, that would certainly be helpful to you, the folks that you serve. However, they want to phase out, for those of us who are self-employed, they want to phase out Section 199A, which is a 20% taxable income reduction that was brought in under Trump to help stabilize the difference between a C Corp tax rate when they lowered it from a higher rate down to 21% where it is now, so that those of us who are self-employed, maybe an S Corp or an LLC or something like that, can help make up that difference and get benefit. Well, Mr. Biden wants to get rid of that. He wants to increase the ordinary income tax rate from 37 to 39.6%. As Brooks pointed out, he wants to lower the estate tax exclusion and increase the estate tax to 45% from the 40% level that it's at now. On capital gain, and Brooks touched on this a bit as well, but he wants to increase the long-term capital gains tax to ordinary income tax rate of 39.6% from the 20% rate that it is now. So he basically wants to double it. But it's important to understand that it doesn't stop with that, because there's also a thing called net investment income tax. And that's a 3.8% tax hit on top of normal capital gains tax. And that would have to be included, which means by including that, that now raises the federal tax up to 43.4%. And then you have California. Now, California does not have a capital gains tax. Everything is ordinary income in California. And with the California rates as they are today, that can be as high as 13.3%, which means if you combine federal with state, you could be looking as high as 56.7% in taxes. So imagine spending years, perhaps decades, building wealth through real estate and other assets that you might have, and ready to enjoy the fruits of your labor by selling those assets, only to face that. That's why tax planning and estate planning are very, very important. And they should be implemented long before, or at least explored long before selling an asset, or of course, some death or incapacity happens in the estate situation. Further, there's a thing called 1031 exchange, which is a very long-standing, very well-known tax deferral approach for investment properties, where if you buy another property of equal or greater than what you're selling, then you get to defer those taxes. Well, he wants to limit that to only a $500,000, maybe $1 million sale. As Brooks pointed out, especially in South Orange County, $1 million for the sale of a property is not that great anymore. So that would have a major, major impact. In fact, there may be a possibility where Biden not just curtails it, he might eliminate that benefit as well. And then lastly, and Brooks pointed this out, is a step up in basis. on inherited property above $1 million. That can have a pretty detrimental effect as well. So there's a lot going on within the agenda that our new president has. And is he going to be able to pass everything that he wants? I don't think so. I think there's quite a rough road ahead for him to do that, but certainly some of these things that he wants to get passed will be passed. And it is going to affect all of us in a pretty measurable way. Now, in what I shared with Julie, as far as what one thing I like to share is there are ways of finding money in the most surprising ways that you might not even be aware of. Now, for those of us who own investment properties, this is principally where we find it, or definitely one of the ways or places that we find it. And this is the thing that I want you to be aware of called cost segregation. Cost segregation is the ability under law to partition out or segregate out certain components that are tied to the investment property and literally change its character from real property that has a 27.5-year depreciation schedule, if it's a single family rental or perhaps apartments, as examples, or a 39-year schedule if it's commercial property, and change those components' character to personal property and accelerate those components to 5, 7, or 15 years instead of the 27.5-year or 39-year schedule. And what that does, folks, it either gives you as the property owner more tax benefit immediately that you can apply against taxable gain on capital assets that you might be selling, or it can give you an instant increase of cash flow tax-free. Why is it instant? Because simply it's that less in monies that you have to give in your quarterly estimates for your taxes every year. And you already have the money in the bank. So all you do is just determine what those tax savings are, validate it under law, and reallocate those monies that you now don't have to pay to doing anything you want. It's a great way of going on a trip. It's a great way for saving for college. It's a great way for saving for a wedding. Multiple number of objectives that could be met just from that. To illustrate, there's a gentleman who had bought a $10 million office building 10 years earlier, 39-year schedule and depreciation. He had taken $2,564,100 in depreciation benefit for the years of ownership that he had it up to that time. Cost segregation allowed him to accelerate $1,358,970 in benefit the first year. And his tax bracket, that gave him an instant increase of cash flow, tax-free, of $475,640. Now, in his case, again, you can reallocate those monies anywhere you want. In his case, he used it to buy more real estate as a down payment and expand his portfolio. But those monies are there. I had a situation earlier this year where a doctor who's in Chicago found me on the internet, and he contacted me. And his situation was that he has a daughter who's also a physician who has her practice in one of his buildings that he owns. And his daughter wanted to buy the building from her dad. And he wanted to sell it, except he had owned the building for a couple of years. It had appreciated in value. And had he sold it to his daughter, he would have a $400,000 taxable gain that he'd have to pay taxes on. And state and federal, that amounted to about $124,000 of taxes. He wanted to sell the building to his daughter, but he didn't want to pay those taxes. So we talked about some different strategies as far as selling the building and solving the tax issue. But then I asked him this question. I said, "Doctor, do you have any other buildings in a portfolio?" Because most doctors do. That's not uncommon at all. He said, "Yeah, I've got several properties." I said, "Well, tell me about them." And he said, "Okay, well, I bought a property 3 years ago." I said, "Well, how much did you pay for that?" He says, $4 million. Did you put any capital improvements into it? Yeah, a couple $100,000. I said, "Stop right there. You don't have a tax problem." "What do you mean I don't have a tax problem?" "No, you don't. Because that building that you just told me about, I can tell you has at least $400,000 of tax benefit available to you. and it will completely offset the taxable gain on the building you want to sell to your daughter. You do not have a tax problem. So he gave me the information I needed. I had my experts run the numbers, and that one I was spot right on. He had just over $400,000 of benefit available to him in the first year by using cost segregation. He sold the building to his daughter, didn't pay a dime in tax. And he had the solution in hand all the time and never knew it. That leads me to something that I shared with Julie the other day. And it's absolutely true. Can you think of what the absolute best investment in this country is? Now, Julie, of course, responded with real estate. And I don't disagree with that. Real estate historically is one of the best investments you can ever make. But I'll tell you what a better one is, and that's tax planning. If you view tax planning, even estate planning, but if you view that as an investment, the benefits from a return on investment viewpoint can be staggering. Now, in the doctor's case, to validate the benefits for cost segregation, the IRS requires that a formal study be done by a third-party expert in cost segregation to validate the benefits per the Internal Revenue Service regulations. It cost him $15,000 to have that study done on that building he sold to his daughter. So consider that fee as an investment. Well, he got to deduct that as an expense. In his tax bracket, his net cost or investment ended up being $8,250 to get a $124,000 tax savings, the return on that investment. Folks, that's a 15 times return on investment with no risk because it's law. So it's important to keep in mind and in perspective what you're doing and have it in the right perspective so you understand and can appreciate what proper planning can really accomplish for you. And indeed, estate planning, tax planning in general can be two of the best investments you can ever possibly make when you look at it from that viewpoint. What other types of properties can be implemented for this planning approach? Here's a representative list. These are not the only things that can be used, but certainly representative of what can be done. So something to be aware of, but it can be very, very beneficial. So deferring and eliminating capital gains taxes when capital assets are sold. So how can that be done? Well, let's first of all understand what constitutes an effective tax plan or tax solution. I believe there's 5 key elements to it. The first one to understand is that when you're dealing with taxes, there's only 2 things you can do with taxes when you bottom line it. You can either eliminate them or you reduce them. That's all you can do, one of those 2 things. And one way of reducing the taxes is to defer them as far in the future as you can reasonably do under law and take advantage of 2 things, time value of money and inflation. We're going to get into those in just a minute. I'm going to share with you just very briefly one technique for deferring taxes that is pretty staggering. Secondly, most planning approaches in the marketplace today really keep the asset tied to the seller after close of escrow. What I'm going to share with you in a moment doesn't. They're completely free after close of escrow. Thirdly, and most importantly for most people I've discovered through the years, is that they'd really like to have a lump sum amount of payment, preferably tax advantaged, that they can turn around and invest however they choose after they receive the monies after escrow closes. This planning approach accommodates that. Most don't. Of course, we want to make sure everything is compliant with law, which it is. And then, of course, we want to minimize risk as much as possible. Well, all 5 of those elements are inherent in this deferral approach. So the question is, what if you could legally delay your tax deadline for decades, giving you the ability to use time value of money to significantly reduce your out-of-pocket tax payment? Well, how do we do that? Well, we couple 2 very commonly used financial instruments. First one is a thing called an installment sale. Installment reporting has been in law now for 108 years. Came into law in 1913. certainly nothing new or untried. The definition, however, in law is perhaps one of the shortest there is in law, because all it literally says is that the seller will receive one or more payments after close of escrow, and that is all it says. So there's no dictate under law as to how much it must be, or how little, or how long the contract must be, or how short. It just simply says that one or more payments will be paid to that seller sometime in the future after that escrow closes. Well, in this particular case, that one payment comes decades later, back 30 years later. So what we do is couple that specific type of installment contract with a loan contract. And the reason for the loan and the importance of the loan is that borrowed funds received under law is non-taxable. For example, have you ever refinanced your home mortgage? Most of us have. When you received those borrowed funds from the bank, did you pay taxes on them? Nope, not a dime. You won't either until you sell the property. So it's no different than that. So what we can demonstrate to those who are selling capital assets, as well as their attorney, as well as their CPA, is how to structure the transaction using a specific type of installment contract that allows them to defer the taxes for decades, yet receive at close of escrow a near equivalent amount of sale proceeds and upfront cash completely tax-free. Very powerful. Now, moreover, for the tax year of sale, we substantially reduce the front-end tax cost for that year of sale. And the way we do that is simply take a small percentage, anywhere from 10 to 20% of the taxes that are now deferred, earmark that to invest, to grow over the deferral period, to have the monies to pay the taxes at the end of that time period, literally out of the growth of what you didn't pay in taxes at the outset transaction 30 years earlier. So by doing that, we reduce the front-end tax cost by 80 to 90%, very typically, which increases your net that you can turn around and invest by that amount as well. To illustrate that, let's say that you had $100,000 of capital today and you invested that $100,000 over a 30-year period, and you just averaged a 5% net after-tax growth rate. Is that realistic as an assumption growth rate? You bet it is, because historically, the US market has never averaged less than 9 to 10% yield over any 30-year period. That's over a 200-year history. So at a 5% growth rate, that $100,000 will actually grow to be $430,000 in 30 years that you would literally have in hand. Well, what are you going to do with that? Well, you're going to take a portion of that and pay the taxes. On the tax side, that's where we bring in inflation. Now, inflation is normally viewed as our enemy, isn't it? Because as inflation increases, costs of goods and services increase, which means we pay more to get less. And we've certainly seen that as of late with gas pricing, lumber, and such. Well, inflation over the last 30 years averaged just under 3%. It's higher than 3% right now, but last 30 years is just a shade under 3% as an average. If we project inflation out over the next 30 years at 3%, by the time those taxes are ready to be paid, they're only worth about 40 cents on the dollar in today's dollars. And folks, that's an effective reduction of pure tax cost of 60%, only because of inflation. So taking advantage of time value money is very, very important. It not only allows for the growth on the deferred taxes that you don't pay for the year of sale, but also allows for inflation to deteriorate those dollars in real tax cost of that deferral period as well, so that when you pay the taxes, you're paying with much cheaper dollars at a major discount in real tax cost. To give you an example, this was a property sale about 3 years ago up in Northern California that sold for $10 million. They had projected taxes of a little over 3.1 million. They and their team implemented this planning approach. They received 9.5 million tax-free at close of escrow, out of which they allocated 387,911 that they invested at a 7.2% rate, which is what they were comfortable with as an average rate of yield. And what that means is that that rate, with that amount of money over a 30-year period, it will grow to end up paying the $3.1 million in taxes at the 30th year. leaving them with an 87% effective reduction of tax costs for the year of sale, which is very, very significant. Now, to illustrate how impactful this planning approach can be, this was a $10.2 million sale. These folks had projected taxes of a little over $1.9 million. Had they not done this planned approach, they would have netted an after-tax profit a little more than $5.7 million. In contrast to that, they implemented it. They reduced their front-end tax costs from $1 million down to $241,224. Invested, grow, to have the money the 30th year to pay the taxes, and they netted free over $7.4 million in hand. So they increased their net tax profit that they would otherwise have. They increased it by $100,000 simply by taking advantage of existing law. We can do this for personal residences, whether they're residences or they're rentals. Same thing. These folks had a $2 million sale. Taxes were $215,067. Would have netted an after-tax profit a little more than $1.1 million. But by doing this, they reduced their front-end tax costs from $215,000 to $26,784, and they netted $1,294,911 completely tax-free. So increased their net by $188,853. What can you do with another $88,000 in your pocket? Probably. Now, let's talk about the example of tax elimination. Then I'll wrap it up. There's several ways of being able to eliminate taxes, but this is one of my favorite ones because it can be so flexible. It's called a family endowment program. And this is a hybrid planning approach where we couple setting up a specific type of partnership, a limited partnership, where the seller of the asset is the general partner, therefore they maintain control completely. And they keep 1% of the partnership interest as general partner, but that gives them control. They give away 99% of the non-voting, non-controlled interest of the partnership to a charitable entity called a donor advised fund. Well, a couple of things happen by doing that. Number one, they're going to get a very substantial tax deduction. Per $1 million of funding, they're likely going to get between $750,000 to $850,000 tax deduction. When that is sold, it's the partnership that is selling the asset, not the original owner. The original owner is now the general partner that controls the partnership, and that person is selling the property on behalf of the partnership. That person now is only going to get taxed on 1% of the transaction, just 1%, not all of it. 99% of the taxes are eliminated simply because of the structure. All the sale proceeds are retained by the partnership controlled by the seller who was the general partner. And that person can invest those monies within the partnership anywhere they want. They can take management income of up to 5% of the value of the assets in the trust. And as those assets grow in value, so is the propensity for income for the management fees. And there's other attributes to this that are very, very remarkable. But this is an example of one case. It was a $1 million stock sale. And if you look at without the Family Endowment Program or FEP, had they sold without doing this, they would have paid $503,000 in taxes, and they would have netted a net after profit of $497,000. In contrast to that, by doing this, they picked up a $427,550 amount in tax savings, not tax deduction. That's dollar for dollar income tax savings. In addition to that, so their taxes were reduced from 503 down to 201,200. They picked up another 236,000. I'm sorry, that difference of 301,800. And their cash flow increased from 497 to 733,800. So the net effect by doing this for them is that they gained $664,350 more benefit than they would have had otherwise had they not done proper planning. This is just one example of what's in law that can be customized to each transaction and to that family in particular. This is our starting point when we're selling capital assets. It's called a pre-sale tax analysis and money flow projection. We do this on every transaction. And what this does is project out what the taxes would be if no planning is done and versus what tax law can provide in benefit if they were to do effective proactive tax planning. In this case, this was $1,150,000 sale of rental property in LA. They're taxable after subtracting out cost of sale and basis was $971,000. On a federal level, there are three taxes. First was capital gain at 20%, depreciation recapture, which is at a flat 25% federally, and then that net investment income tax that we talked about earlier. So the total projected federal taxes was $238,498. California, once again, is all ordinary income. So for that level, that was $112,547. So their projected taxes were just over $351,000. So had they sold the property, paid the cost of sale, paid the taxes, they didn't have any debt to worry about in their case, they would have netted $729,955 on a $1,150,000 sale. Instead, by using this deferral approach, they netted $1,009,446 tax-free. So they increased the amount that they received by $279,491 above what they would have had otherwise as after-tax profit had they not done this. And just setting aside $61,120 of that money that they received, earmarked to invest, to grow, to pay the taxes 30 years down the road, they still netted $948,325, or 30% more than they would have had after tax. In this instance, because the property was debt-free, we also looked at the family endowment grant. In that instance, they would have netted $939,500 after all setup costs. That's what would have gone in the partnership. Their annual income distributions would be $46,975, which again has the propensity to increase as the value of the partnership increases. But they also would have gotten a $293,034 income savings in addition to eliminating the capital gains tax by using that particular approach. In their case, they chose the deferral approach.